welcome to the Fireside Chat. What we've done is we've come up with some questions that Dan and I get asked a lot. I'm going to ask Dan the questions and he's going to answer those questions. If there's something that we haven't covered, again, feel free. We're going to have lots of time after but we're hoping that with the questions we've come out with, it's going to answer a lot of your questions. And they're not in any particular order, so it's not from any kind of priority, okay? It's just things that, as I was thinking about it and Dan was thinking about it, we came up with the list. So, Dan, and I was talking to the security guys when I came into the building late today, and you know about the recession and what's going to happen going forward. So there is a lot of talk about a recession pending. What should investors be concerned about regarding their portfolios as it is right now?
Right. So, I mean, there's a lot in this question. It's not just with the portfolios. So, and I'm sure you guys have read, the media has different opinions on the probabilities or odds of a recession. A lot of, I don't know if you guys watch CNBC, but a lot of experts there think low risk, 40% risk, etc. This is not based on any scientific evidence, but our gut feeling is that the probability of a recession is much higher than even 50-50. So we would say that the likelihood is 55, 60, maybe even higher. We're quite certain that the economy with higher interest rates will slow down. It's a question of degrees, and no talking head on any box in the TV knows to what extent. Because there's just too many moving parts and random variables. And this is the thing with, you know, the media. These guys come on with their suits and ties and talk like they know what's going to happen. And the honest truth is they don't. You know, you go back to January. Could anyone have predicted with any degree of certainty that Putin was going to invade the Ukraine? That oil was going to go to 120, you know, that, or you go back even further, that COVID was going to cause it's not so much COVID so much as the response to COVID that is kind of causing a lot of these inflationary effects that we're seeing now with stimulus spending, excess money supply growth. And now you add to it the high oil prices. And the only policy tool that the government really has is to raise interest rates. So with all that kind of going on, what should investors be concerned with respect to their portfolio? Well, I guess at the end of the day, any investor is really concerned with the value of their portfolio, right? And they want to see that value maintain and hopefully continue to grow. You know, in this kind of environment, it's very challenging. S&P is down 22%. NASDAQ is down 32%. You know, one of the few investments that worked until recently was oil and gas, which hadn't worked for a decade. You know, so it's one of those things. I know our portfolios are a little light in that area. It hasn't proven to be a sustainable investment, and now we're getting, you know, questions as to why we don't have more oil and gas or copper in the portfolios. So the other kind of whammy that's hitting the portfolios is the bond market. So as inflation has risen, and I mentioned the only policy tool that the central banks, the key one being the Federal Reserve in the US, has is to raise interest rates. As interest rates go up, bond prices have to fall. That's just straight bond math. So if you're holding a bond directly or a bond fund, the value of those bonds will, the second the rates go up, are adjusted down instantly, unfortunately. And even if that's kind of anticipated, there's not a lot that these portfolio managers can do, unfortunately. So now you have the situation where the equity portion of your portfolio is falling. The bond portion, which is meant to be our stable kind of ballast, if you will, is also falling in lockstep. Not to the same degree, but enough to cause kind of a little discomfort as more than we would like to see, actually. So now you have both sides of your portfolio like struggling. I guess that's the main area of concern, really, is how this affects the value, how it affects it going forward. How long can we expect this kind of turbulence, and so on and so forth.
So thank you for that, Dan. You're getting in some of my other questions, so it might be a repeat later. But one of the things that, clients and I'll say people in general are talking about all the time, it's such a roller coaster because we can get one day where it's going up and we get, over enthusiastic and thinking that maybe this is the turnaround. And then we start going down on this roller coaster and it gets a little scary emotionally, just like when you're on an actual roller coaster, it's the thrill and of course the scariness on the whole thing. Well, that's what the market seems to be doing right now for people. And it's like, how do they protect their money though, when it's like, you don't know if you should be going forward in or getting out because of this up and down yo-yo kind of thing of a roller coaster.
Right. Volatility is an interesting word because volatility means up and down. People don't seem to worry as much when their portfolios go up, which is great. But of course, it's natural. It's a natural emotion to worry when it does go down. It's disconcerting for us as well. To be honest, the best way to protect the portfolio, and I'm going back 120 plus years of stock market history, and I've talked with you guys about this before, but is really diversification, careful picking of assets, and really just, income coming into the portfolio, and then patience, unfortunately, is key here. Getting back to kind of the bond conversation, and I've talked to not the PM so much as the holders the staff at these bond funds. And one of the things that's interesting is, even though these bond funds, for example, are down, within 2 to 3 years, that cycle should have played itself out, and we should make 100% of our money back plus. Because if you think about it, as these interest rates on these bonds are holding out come in, or the bonds mature, they get reinvested at these new higher rates. And those new higher rates obviously yield you more. And within 2 years, possibly less, we should be at par. It's the same on the equity portion. We don't carry, our preference is not to carry high risk equities. Most of the equities that we choose pay dividends. And the same with some of the funds we use. They look for equities that have either strategic advantages or are growing their dividend yield. And that is one of the best ways really to protect your portfolio, is that equity income. One of the kind of key areas of uncertainty though is inflation. How long does it stick around? Is it persistent now? Can they get it in check? But most companies, believe it or not, can actually pass through higher prices onto the end consumer. Not all companies. And actually, it's interesting. Tech companies have a harder time than, for example, Coca-Cola or Procter & Gamble or Johnson & Johnson from passing these price hikes through. So, that's where kind of the diversification plays into this equation.
So I've been looking at my statements lately and getting quite emotional. What should the next move be?
Well,
we get this a lot, Dan, because even lately we've had clients saying,
Linda, I'm thinking about your portfolio specifically. Linda likes risk.
No, I'm not. I actually take the stance, if all the news is negative and I'm working in the environment and I know that, I don't open my statements. I don't need to know and see the pain, but we do get people commenting all the time, and we have to address it. So that's why I'm asking.
listen, again, we're always driving forward, looking backwards with investing. What one of the and it's everyone's at different stages of their life. So someone who's just retired and this is their nest egg is a different situation than a young person who's still accumulating. Let's start with the younger person. They should just keep dollar cost averaging in to these funds. I don't know if it's 2 years, 3 years, 10 years. This ship will right itself. As even though governments have massive amounts of debt, they're not going away. So that kind of situation, that person should dollar cost average in. Unfortunately, if you're not accumulating money, it's a little more disconcerting, but really the tried and true kind of strategy that's worked and has proven so has been to stay the course, stick with your strategy, and stay invested. Again, it's easy to say, it's a lot harder to do.
And tell them about, because you did that little thing recently, I don't know what graph it was, but where, of the percentages of markets going up or down and then eventually becoming 100% up.
Yeah, so it's on any given day, the stock market, and I'm not sure if you guys are aware of this or not. I was an equity trader for the better part of a decade. I sat at a desk. I had 6 computer screens. My eyes were dashing back and forward to all 6 all day long, and I had the hardest time when I'd come home focusing and concentrating after that. But on any given day, the odds of the stock market being up or down is exactly 50%. So 50% chance down, 50%. There's no better odd one way or the other. So it's random. On any given month, it's slightly better where you have a kind of a 55% chance of being up and a 45% chance of being down, but not too far from random. And as you move further out on any given year, it's about the same, a little closer to 60%. But as you kind of fast forward and you move out to 10 years, there's a 90% chance of your portfolio being up and a 10% chance of it being down. And as you go out another 10 years, there's actually a 100% chance that your equity investments will be higher. I mean, almost a 0% chance of it being down. Now, those are long numbers, but if you go back to the 10-year, the 90-10 those are not bad odds. And even at 5 years, it's a lot closer to 80-85% chance of being up. And so kind of our strategy really has been one of capital preservation, which I can get to in a bit, and try to get that income coming into the portfolio. So even if we're down 6-7% on the portfolio, we know that in 2 years with compounding, a little less possibly even, we should make that back. Markets won't go down forever and they won't go to zero. And I'm sure you guys have checked your statements. In dollar terms, it's never fun, but in percentage terms, and we just did a comparison, most of our portfolios and even the mutual funds we have, but more our portfolio is down 6.5% year to date. It's not great if $1 million, 6.5%. Well, yeah, that's 65 grand. But when you compare it to how the overall market's doing, I think we've done an okay job. Could we have done a few things better? Possibly, but it's not too bad in our opinion.
Okay, thanks for that. So I'm still concerned that if I stay invested, I might lose my money and I won't be able to have, I'll say, enough for retirement. Excuse me, what should I do?
So this is a really tricky question. And there's, again, many factors at play here. One that has crept out of nowhere, so to speak, is inflation. because the price of everything is going up at the same time as your portfolio values are declining. So one thing that you can do really is take risk off the table. It's really about comfort, because you do have to be able to sleep at night. You may want to leave a legacy, etc. But in our opinion, the ideal kind of solution is to stay invested. Your money is earning money. So that's kind of what we suggest. But again, we do have to operate within comfort zones.
Thank you. And I think also, just to add my little 2 cents in, if you've got a fully invested equity portfolio, it would make it a little bit more difficult if you need money. And so if you have liquid cash and have an emergency fund, going through, going through these times that we're going through right now will have very little impact on you. It's those people that, I'll say, during the times when the markets are going up and they get greedy and want to put everything up in more speculative. The one thing with Dan and I, we don't invest that way. And as he said, we're on the moderate side of, equities. We love equities, and you will make your money back in equities. And I know that going and taking off risk, if you've got a lot of risk, is what you should do. But for those, like most of our clients, they have very good, solid portfolios. And the dividends that is going back and getting reinvested is dollar averaging on your behalf. And if you take off too much risk, again, like Dan said, it's a comfort thing for you. But if you take off too much risk, you have chances that you can't recover from, where we are today. And this happened in 2008 and 2009. And I only had, I think, because Dan wasn't with me at the time, but I only had 2 or 3 clients that literally went to cash. Now they took their money to the bank, because I don't deal with people that go all cash, because then you solidify your losses. But you can't, when you see something on paper, it's not your price if we're not selling for you at that point. It's just somebody else. And you can feel sorry for those people that are going down 30%, feel sorry for them because they may have to take the money out. But that's not what we do for our clients. And Dan is very good about making sure that we've got solid portfolios. And that's why he doesn't want to brag, but I'm bragging for him. It's why we're so proud of the investments, because they've had such a little downside compared to what the markets are doing right now. And having said that, they're going to come back that much faster because of the income that he's made sure it produces. So that's just kind of, again, what you should do is not be too concerned in the short term. Even like Dan said, it could last longer than we expect, because we don't know. Nobody knows. But the reason you go into the markets, obviously, is to get that bump up in return. And even though interest rates are starting to, claw their way back a little bit up, because when Dan showed me the GIC rates lately, they were a lot higher than they've been for so long, which I don't think we could get you 1% at one point. And now they're over 3%, I think, So I kind of answered, but Dan, I'll still let you answer this next question. Will the markets ever go up again?
Yeah, the answer is yes. Our kind of take right now is that the markets are going to go up and down for quite some time. The past decade, and even especially since COVID, is kind of unprecedented with gains that people have had. But we do think that that we will at some point return to some level of normalcy, and companies that are making money will grow. Their value will grow. And just like Linda said, that when will. Nobody really knows that, and that's kind of where staying invested is the right thing to do. We've seen, and it's been well documented, that people who get out of the market usually don't get back in, or get back in way too late. Once they grow the courage to go back in, it's generally the end of that cycle. And that's, greed and fear of missing out really drove a lot of the kind of end of that rally back pre-Christmas season, where everyone was talking Bitcoin and I don't know if you guys are familiar with the term SPAC, and all these tech companies could do no wrong. And now these companies that aren't making profits some of them are down 80, 90%. It's kind of like a pseudo 1999 all over again.
Well, one of the things that Dan and I talk about a lot is sometimes we do get people requesting to get into speculative stuff. And then, like you said, you can, be up and then all of a sudden you don't want to take the profits off and now you're down 90%. So if a client actually wants us to do that because they can spare that money, it won't impact anything, then Dan always suggests a little bit just to get in there. And that way, you can be part of the run up if it continues. And if you do go into the rundown because you wouldn't take the profits, if they did go into profits, then at least you're not going to impact any kind of, lifestyle, whether it's retirement or anything else, if you're still raising kids and all that, not that you are here, but in general. And so it's one of those things where we're not telling you you can't do it. We're just suggesting that you do small things when it's more speculative. So, and Dan, you started answering this because a lot of times what we're hearing from clients is, I'm hearing in the media this time it's different. What makes it different? Or does the media just have it wrong? And that's what they're always like, the doom and gloomers kind of thing.
Yeah. So, and I said this all throughout COVID, the media makes money spinning bad news and scaring people. The more they can scare you, the more they can drive eyeballs to their print or circulation or feeds, the more they can sell advertising. And it's kind of a dangerous cycle, in my opinion, as you don't always get full disclosure. You get partial reporting, half truths, and edited material. Is it different this time? It's different every time.
It's a good answer.
Yeah, but one thing that does worry us, is these unprecedented levels of government debt at a time when rates are rising. I forget the Scottish philosopher's name, but these cycles can at some point, if this isn't brought to some kind of normalized thinking, could ruin us all. But high interest rates at a time of unprecedented government debt could explode. And the big risk in the world actually isn't Russia's invasion of Ukraine. It's the Italian government. The Italian government has mountains of debt at a time when so Italy has 60 million people, I think, give or take, is in the top 8 of the biggest economies in the world. But I think they're number 1 in debt, or number 2 behind the US. So at a time when rates are rising, this creates kind of that fear. Canada was pretty fiscally responsible until a new leader took over, and we've kind of lost our way there as well, following the US in that respect. But that's kind of conjecture. Like for the most part, these are still manageable levels, but that's kind of the ultimate worry. And if that happens, by the way, if the US in theory can never go bankrupt, and because they can always print more, which that's how you get inflation. The investments won't matter. Like you'd be better off with farmland. I don't know that gold would even save you, but farmland would be your best friend, a cabin in the woods or whatever, where you can grow your own tomatoes and hunt rabbit or something. So the investments at that point become moot, really, unfortunately. So that's...
Well, you've kind of answered the last question that I had. How will inflation impact my retirement and my investments? And I guess with the high prices of everything, if you, could, I'll say manage in the sense of, being out in the country and raising your own animals and, growing your own food, I guess that would kind of help. But, one of the other things, and I was newly married during the 70s when we were in high inflation. And back then I was working for the government, so I had no idea what inflation even meant because I went to work, I got paid. My ex-husband was a railroader, so it was like government at the time before it went to Crown or whatever it was, or it went from Crown. But anyway, whatever it was, the fact was he had a steady job. We got regular income. And even though we were in a period of high inflation, we never felt it because we didn't run our household on debt. And for the most, and for our clients, we're very fortunate. We have clients that are very money savvy in the sense of, I can't even think of anybody who's like in excessive debt, because our clients understand if you've got money, you've got power. And so not running debt, because these high interest rates that are going to continue to go up are going to hurt a lot of people going forward. You might not even notice once we get through this and look back that we were in such a period of high inflation, other than going to the grocery store and the gas pumps and seeing, the pricing. If you can, I'll say, watch the expenses during periods like this, so you're not taking out excessive amounts of money out of the portfolio when it's paying you to stay in, really. Now, we always have to pay minimum amounts at a certain age, but before that, you always have the opportunity to just take out just what you need and just let the rest of it ride, and they take the income that's coming. And whether it's the income that's going to pay you or the income that gets dollar average for you. Dan structured the portfolio to help you, I'll say, go through this period of inflation and this recession that we're headed into a lot easier than other people are going to find it. That's just my 2 cents on that, because inflation will impact everything if the cost of living goes up. And Dan and I do a presentation and we talk about, the price of a cup of coffee, back in the 70s, or a stamp back in the 70s versus what it costs you today. I mean, that's inflation, and you need your money to continue to grow. And the only way you can do that is with equity type investments that are paying you these dividends. And so that's just kind of what, it will impact, but I think that most of you, at least our clients, are going to be looking back and thinking it wasn't too painful once we're through this. Dan, do you have anything that you wanted to add to that?
No, that was good. Yeah.
Okay. Do you have any questions? Okay, well, that was all we had for questions. Dan, unless you have anything that you wanted to add that we didn't cover.
No, not off the top of my head.